Welcome to Bridging Finance 101, kindly sponsored by Together. During this webinar, I'm going to talk to you a little bit about the basics of bridging finance. We're going to look to dispel a few myths and touch on some of the key statistics throughout the 2019 lending period. Hopefully by the end of this, you'll all feel a little bit more confident in bridging, or you'll have some statistics that you can talk about with your customers whilst you're talking through the benefits of a bridging loan when you're trying to solve some of those more complicated solutions that your clients come up against. So once again, thank you for Together for supporting this webinar today, and I do hope you find this of interest. So to begin with, a basic definition. So what is a bridging loan? A bridging loan is simply a short-term loan. The normal maximum term on these is 12 months. There are lenders now that will look at 24, possibly even 36 months for the right circumstances for your clients. But as we'll touch on a little bit later, the term of the bridge is important. So it's certainly worth considering your lending avenue dependent on what your client's looking to achieve. There's no one size fits all approach. For some people, one lender's best. For other people, it's another lender. It really all depends on that lender's pricing model and the actual risk of the deal that your client's looking to do. But in short, bridging finance is a useful solution. It's a problem-solving product. It's not something that you'll tend to have people walking in saying, I'd really like a bridging loan. However, you will be faced with scenarios where bridging might be the only option, certainly might be the best option for your clients in order to proceed with. And we do think that we are experts in bridging finance. And again, last year we were rewarded with the Mortgage Introducer Award for Bridging Broker of the Year. We do a lot of bridging finance. Our completions last year were 20% up on the year before, and that continues to grow into the start of this year as well. But it is key to remember that they are a short-term solution. They are only part of the solution as well. The most important part of a bridge is the exit. So again, we'll touch on that a little bit later on. But the typical scenarios here would be something like a refurb or an auction purchase or a chain break, something that mainstream finance might not be the best solution or the best avenue for you to go down. So Together has published some research along with Mintel research, and we're going to touch on a little bit of that today as well, and hopefully dispel a few myths of bridging finance. And there are a number of views that have become antiquated, and it does hinder the growth of the bridging sector. Again, bridging isn't a solution for everyone, but it's a really good solution for many. So the first myth that came out of the research was that bridging loans are too risky. Well, what some of the statistics have shown is that the average loan to value on a bridge last year was 52.9%, which had actually fallen from the year before. As long as the customer has a firm exit strategy in place, and again a prudent loan to value that they're not trying to borrow above their means, then bridging loans don't necessarily need to be high risk. It is a short-term solution, again, as we've touched on a number of times this session already, but it's a way to get from A to B. As long as the B is being worked on, or there is an actual feasible plan to do that, possibly a sale, refinance, a refurb, something along those lines, then bridging is a great solution. It doesn't need to be a high-risk product. If people go into bridging to either do credit repair or hope the market will change in a period of time, then it does open up a little bit more risk. And again, we have seen a drop in the number of below market value bridges that exist out there. There are still people that will do below market value purchases, up to 90% of purchase, possibly even 100% depending on the lender you go to. But the criteria to get that nowadays is much stricter than it used to be, say, 5, 6, 7 years ago. Again, from the lender point of view, what's the skin in the game? What risk is the client taking in order to get this deal done? If that risk is shared, the lenders are then happier to proceed with the case. But it doesn't have to be risky. We're also seeing a rise in regulated bridging as well. The bridging trend statistics show that 39% of bridging in 2019 was actually FCA regulated, compared to 36% the year before. And again, that's backed up in our own completion numbers. So what we're seeing there is it's much more of a mainstream product now than it ever was before. And there's a number of factors behind that. The lenders that are getting involved now, and there's a number of banks doing bridging. There's a number of FCA regulated lenders that are doing bridging. It's not necessarily a backstreet product anymore. It's not run by finance companies that no one's ever heard of. So therefore that increases bridging's appeal. Because you have lenders lending in the regulated bridging space, it also means that processes are much more under scrutiny, that pricing is much more under pressure. So therefore, when the product becomes cheaper, it's much more transparent, it's much easier for customers to understand, and it's offered by much more reputable firms. It suddenly becomes much more of a viable option, much more of a solution that clients that are happy to proceed with. The second myth is that bridging finance should only be used as a last resort. Again, that's not necessarily the case. It can be the go-to option to take advantage of an opportunity. If you need to complete on a property purchase quickly to take advantage of either a great price or an opportunity for the property being available, again, bridging is potentially the way forward for that. We've done a number of bridges last year in less than a week. Now, the average completion time for bridging is a little bit longer than that. You're probably talking anything between 30 and 50 days. However, when speed is the driving factor, when speed is of the essence, how many of you could complete a purchase in the mainstream mortgage market in under a week, for example? It just doesn't happen. Bridging lenders are much more adaptable. They're much more manual, which means that you keep that versatility. It means that the lenders can adapt very quickly to changing market types. So the Mintel figures again show that 24% of bridging loans in 2019 were used for investment purposes. So a typical scenario there would be, let's say, a purchase at auction or a purchase of a property that needs a bit of work doing to it. You can take that property on a bridge, get 70-75% of purchase price, do the work you need to do to increase that value very quickly, and then exit onto much more cheaper, much more sustainable long-term mortgage finance. Again, you've got products now coming to market such as refurb to let schemes where all of that can be pre-approved. So as long as it goes to plan, the exit is already pre-agreed with that existing lender. So again, it adds to the attractiveness of looking at a bridge to solve these problems. On the second figure there, 20% of bridging finance was used for chain break purposes. So a property's on the market waiting to be sold, the client wants to buy another one, that property is available and something stalls. What happens? Do you miss out on the purchase or do you look for an alternative solution? And again, a bridge is an option to do that. A chain break can be secured across both properties if loan to value is an issue, or it can be secured on either the sale property or the purchase property, all dependent on which suits that client's requirements the best. And again, 12-month typical term, that gives the client 12 months in order to sell that property. Most lenders will now work with the borrower during that period in order to gauge appetite on the sale. How many viewings have there been? Have you had any offers? Do we need to discuss dropping the price of the property in order to get that sold, so that you do miss out on any potential negative impacts of going over term on bridging? But we can see they're two relatively mainstream purposes for bridging finance, where you wouldn't necessarily think of that as being a last resort. Myth 3 that I'd like to bring up is pricing. People think pricing of bridging is expensive. So in 2019, 79% of all bridges that Crystal completed were under 1% interest. Taking that a step further, 21%, so 1 in 5 bridges that we completed last year were priced at less than 0.6. And that's a staggering figure if you consider where rates were even a few years ago. Bridging Trends figures are talking about an average monthly interest rate dropping to 0.74. So that's an average. So when you consider development bridging or heavy refurb bridging is priced at over 1%, there's a vast majority of bridges there that are done very cheaply. The lowest bridging rate that we have access to in the market is 0.42% currently. So when you consider that's just over 5% annual for a bridging loan, I don't think that's too expensive at all. So we've looked at reasons why people will bridge, and there are many advantages for bridging finance, especially when compared to other finance types that are available. However, it is very important that we don't just take a blanket approach, that we don't just think, right, everyone's getting a bridge because I can do it quickly, I can earn a good proc fee and I can earn twice. That's by far the wrong message to be sending out. When it's only required for a short period of time, bridging is often the cheapest option. If you can take that, 0.45, 0.5%, take that for a couple of months, again, it's a lot cheaper than paying ERCs on mortgage products and things like that. They're also very quick to arrange, but also flexible lending criteria. Again, something I touched on earlier. Most lenders that do bridging still have manual processes, which means that approvals can be given quickly, that they can be secured on all types of property, and if something does come out of the blue, a down valuation, or the client's having difficulty providing some information, there's much more dialogue that can be entered into around that. Why can't we get that? What can we get instead? And how can that work? Lenders are also much more flexible when it comes to property types. So if a property needs refurb or would be classed as traditionally unmortgageable, or possibly even when you get one of those dreaded nil valuations from a mainstream buy-to-let lender, properties very rarely have nil valuation. They might not necessarily meet the risk appetite for the lender that you're going to, but that doesn't mean that the property is worthless. Every property has a value, and therefore that value can be leveraged dependent on which lender you go to in the market. So a few other scenarios where bridging could be used: short-term cash flow options. So businesses are always in need of cash, especially when we get to kind of January, when we've got the tax returns to pay, or when it comes to VAT time, when it comes to new contracts that people need to enter into. There's always demands on business to have cash available. If there's equity available in a property, then bridging finance can be used to do that, and that may be more suitable than invoice factoring or discounting or any of the other scenarios that are available. But as a good business advisor, as a good financial advisor for your clients, you should be considering all of these options when a client has got the finance requirement. Inheritance tax and probate issues. Again, we can lend to trusts, we can lend to settle probate for properties. So it does make it a very viable solution when other finance opportunities might not be available. Repossession prevention. Again, a very popular reason for bridging. A client's in financial difficulty, wants to sell the property, but might not necessarily be meeting the timeline dictated to them by the existing lender. Now, whilst bridging shouldn't be used for credit repair, what it can be used for is to obtain a market price for the property rather than a forced sale price for the property. So therefore it gives your clients another opportunity in order to maximise the value within that property. And again, at the bottom on there, property development. There's a very fine line at times between development finance and bridging. Sometimes you need one, sometimes you need the other. Sometimes the same product, sometimes the same project might need the two different types of finance available to it. For example, purchasing a property without planning in order to obtain that planning permission, that could be done on a bridge. Once planning has landed and has been granted, that can then be exited onto development finance, which is much more GDV structured, which is much more funding, kind of almost forward funding or providing funding at stages. And then exit afterwards, either onto a term loan if the client wants to keep it. There's a number of developer exit products there, which give the client a longer term solution rather than just the development finance ending when the build finishes, or even if the client wants to sell. And there's various options there. It is important to consider how to fund developments with your clients, because bridging traditionally runs in arrears. If the client does some work, property value increases, they can borrow a little bit more. But again, not all lenders do that. A number of lenders don't want to do further advances or stage releases beyond the initial drawdown. The other key bit to remember during a development project is that the value of that property may fall during the work. So let's say it's worth 100,000 today, you do some work to the property, you might strip out part of it, you might demolish part of it, and then what happens is that property is actually worth less now if it was to go to market. So what could happen is, if you're on traditional bridging finance, for example, is that you send the valuer back out to give you a new market value of the property. It's actually fallen, so there's no additional funds to be borrowed, which is where sometimes development finance kicks in, because they are aware of that and they can factor that life cycle of the project in. Then heavy refurb, light refurb, what used to be almost a tart and turn type product, is perfect for bridging finance. It's really important that you do consider the correct product when looking for a solution for your client. There are a number of advantages to bridging finance. It is a short-term finance option, and the monthly interest rate, typically, if you were to compare it to, one of our advisors the other day was talking to me about a buy-to-let product that was sub 1.9%. I mean, that's amazing pricing. But that product might not be available for your scenario. So yes, bridging at 0.5, 0.6 does appear more expensive than those. It's certainly much, much cheaper than it used to be. And again, the most important part of a bridging loan is the exit strategy. At the end of the term, the bridging needs to be repaid. Different lenders have got different models when it comes to this. Some will charge an overrun fee, where they They either put the interest rate up or they charge a fee for the client going over term. Other lenders will renew the facility and make a charge for that. Some lenders will keep the loan running at its previous interest rate, just expect the client either to pay monthly or to build up that interest, to roll up that interest on top of the loan. And other lenders will literally just draw a line in the sand and say, no, it was a 12-month loan, we want to repossess, we want our money back. So it's really important that you consider that pricing model when you're looking for your bridge. If the client needs a 6-month bridge, don't take a 3-month term in order to get the maximum net loan. There's still a responsibility there to ensure that your client has the right product. Again, if you're taking a buy-to-let refinance on a property that's being refurbished, and that lender has a 6-month ownership window before they'll consider a refinance, don't take a 6-month bridge, because you get to the end of the bridge, the client is then in default, and whatever that lending does at that point, you then start the application process for the buy-to-let, which could take 3 months in order to go through. It's better to take a 9-month term in that scenario, because you've then got the time in order to get that exit planned. So it's all about thinking through the whole transaction, thinking through that, both the A to B bit, which is the bridge, but also thinking about B. Let's make sure we get B correct. The appeal of bridging finance is that flexibility. It's the speed of arrangement that can really help in tight scenarios. It's that flexibility of criteria. Generally, the lenders aren't too concerned about income. If you were to come to us and say the exit's a refinance, the client earns £1,000 a year, but he's going to get a mainstream residential mortgage on that, and obviously we're going to ask some questions. We're going to have to dig into that a little bit more. But if the exit sale or the plausibility of that deal is correct, then lenders are much more flexible. Again, credit history. If you're buying a property to improve and sell, and you've got a few mortgage arrears from a year ago, the lenders take a view on that. It's not something that really concerns them, because the security is within the property as opposed to being on that borrower's profile. And again, the vast majority of bridging finance is rolled up or retained, so the client doesn't have any monthly mortgage payments to make. So again, that gives the lender additional security there that they can retain interest payments for a period of time. All types of property can be used as security. Again, a real big growth area in bridging has been short lease properties. A property with 10, 15, 20 years remaining on the lease is not really attractive to mainstream lenders. However, once that lease has been extended, it makes that property mortgageable once again on the mainstream. So again, a typical use for bridging finance is to buy these properties because they are going cheap, because it does tend to need to have a cash buyer behind it. Do the lease extension, maybe even a small refurb at the time, and then put that back to market, or put that back to the mortgage market as a much more attractive proposition. And we've seen a number of developers make some good money from doing that, where they can turn that property around and sell it back to market really quickly. Property in a poor state of repair, again, we touched on that earlier with a bit of refurb. Lenders are happy to look at those. Similarly, non-standard construction, if there's a plan to do something with that property, something that lenders will consider from there. And again, another real benefit for bridging is that multiple properties can be used as security. So that can include first charge, second charge, combinations, or even there are lenders out there that are doing third charges on properties as well. There's some further stats from the Mintel research we did together. It's that commercial and development loans accounted for 2/3 of the bridging loan market. The 2019 estimation is that value is around about £5.5 billion. Commercial there at 34%, development at 32%. One of the difficulties is actually quantifying the size of this market, and actually knowing how many deals are done. So the growth in commercial bridging finance has been spectacular. As I touched on earlier, 20% up for bridging for us last year. Since 2015, the value of commercial bridging loans has grown by 99%. So what we're looking at there, 1.38 billion in 2015, up to 2.75 billion in 2019. And again, there are various factors that we can look at as being causal to that information. The simple fact is that the products now are much more accessible, much more transparent, and much fairer than they've ever been before, which means that they attract a new type of borrower. Development finance, and that market's increased by a similar amount, 1.43 up to 2.73 billion in 2019. Again, just showing the flexibility, the versatility of these lenders, that they can look at market spaces, they can look at trends, they can look at issues within the property space and adapt very quickly in order to jump through and to solve those issues for clients. However, we're not there yet. So only 7% of small business owners say that they have used a bridge. However, 27% have told Mintel that they would consider using one in the future. So there are various reasons why a business would use a bridge. Again, we touched on earlier, working capital, emergency bills, expansion, refurbs, things like that. So therefore, just over a quarter of businesses would consider using bridging finance. So it shows that the market has still got a considerable way to go if less than 1 in 10 have used it. So bringing this to life a little bit more, one of our brokers contacted us to arrange a commercial loan for a client who'd been left down at the last minute, buying 6 retail units at auction. The deadline was fast approaching. Failing to repay the loan meant the client would have had to pay substantial penalties. So our team quickly identified that the best option, the quickest option here was to arrange a bridge. So we managed to get a lender that would take a comfort charge on another property, even though this was already mortgaged up to 70%, so typically there didn't have any mortgageable equity within it. The solicitors were instructed within 3 working days of the inquiry, and the bridging loan completed, 4 months retained, 8 months serviced. So it was a 12-month loan. First 4 months were deducted, and the client then had to pay the following 8 months monthly payments. This allowed the client to get the maximum net advance at the minimum cost. You don't have to take an out-of-the-box product. They can be made bespoke to suit what your client's looking for or to suit the best option. An expat rebridge that we did with together completed within 15 days. A businessman based in Monaco needed to clear a £5 million bridging loan, with the remainder paying for a substantial refurbishment of the flat. Once completed, the property value would increase from 10 to 12.5 million. Complexities here involved the property being owned by an offshore limited liability company, LLC. And again, one of Together's strengths there is the flexibility, so we were able to source an offshore opinion and get this case completed within 15 days. So again, rebridging is another great example where clients either got the term wrong on the initial loan, a snag hit. If you've taken a refurbishment loan over the last few months, the weather that we've experienced over the last few weeks has been certainly unusual, to say the least. And you could imagine a number of refurbishment projects just haven't been touched. So therefore, if you've taken a relatively short-term loan to suit cash flow over that period and have lost 4, 5, 6 weeks out of that window due to weather, you could end up needing to rebridge that in order to get that project finished. So Crystal utilised a forward-funded bridge to ensure that the developer could cover both property and build costs. The purchase price, $75,000, with detailed inspection of the build schedule and the drawings, the surveyors could estimate the end value of 110. So therefore, on this one, we could source higher loan to values. We could source money towards the works, despite it being over the traditional 75%. This completed within 4 weeks, undertook the work needed, and then applied for a bridging loan at 82.5, so over the initial price, with less than a month passing from purchase to today. It meant the client could raise capital, go and do this again, make the money work harder for him. So the market in a nutshell, these are correct as of today. Obviously, loan to values, rates and things change quite frequently. Loans are available from £10,000 upwards. Realistically, there isn't a maximum figure that people will do. Once you get above 3 million, the market restricts slightly. Once you get above 5, it restricts a little bit more. But there are lenders there that will go up to 30 million plus. Lenders will use desktop valuations now where possible, which is something that's quite new to market. So an AVM that you might get in the traditional mainstream space. If we're looking at a traditional residential or buy-to-let property, then lenders are now happy to use these on bridging finance as well. Lenders are also happy to use dual representation a lot of the time, where the same solicitor acts for both parties, which can again reduce the time and also reduce the cost of the bridge for your client. Typically, lenders don't ask for income verification. Again, maybe if it's a refinance, that they might ask for some proof of that to show that the exit's achievable. Or if the client's servicing the bridge, then the lender, of course, will want to see that they can make those payments. But it just gives a little bit more flexibility, especially where we've got complex income structures or we've got overseas income that can take either a while to get hold of or can be quite complicated for some people to understand. Many lenders there now don't charge exit fees or don't charge upfront fees as well. So This is all in the pricing model of the lender. The lender's price for risk. So if you are going to a lender that offers a rate of 0.42, then their risk appetite, as you can imagine, will be extremely low. If you want a deal done where we're talking about an unmortgageable property, a high LTV with heavy adverse, then obviously that rate will increase. And lenders make that rate work for them in different ways. Some charge higher fees at the start, some charge higher fees at the end and reflect that in a lower interest rate during the period. Others won't charge those and will charge a higher interest rate during the period. Again, this is where a good financial advisor, even a good packager, can really work with you to add value to that transaction and to ensure that your client gets the very best product available to them. Again, as we touched on, they will consider adverse, they will look at below market value. Although it is more restricted than it used to be, there are still lenders out there that will do that. So if your clients are genuinely getting a bargain for whatever reason, a sitting tenant, or they've made an off-market offer for a property, and the valuer agrees that it's worth more than the client's paying for it, then LTVs can be stretched to do with that. The other way that can work, of course, is using additional security, where we can charge multiple properties to even get 100% or 100% plus refurb on property types to make that work. And again, any and all property types are considered. The more weird and wonderful the property, the smaller the target market. But we have done bridges on a variety of properties, a variety of values in a variety of locations. So it's certainly worth picking up the phone, speaking to one of the guys at Crystal, and we can advise on how we can best assist with bridging finance. The process for a bridge is really simple, and this process normally applies whether you're using us, whether you're going straight to lender, or whether you're using someone else. First of all, you need some terms. So discuss the deal with the deal maker. Discuss it with someone that can understand the products and lenders on offer. And at Crystal, we aim to come back to you within 4 hours. We then need to make an application. So where we don't need any money, where we can use a free valuation or something like that, then obviously we'll look to do that. Otherwise, we might ask for a valuation fee so we can get that valuer out and back as quick as possible. And again, valuation fees, if it's a traditional residential property, they're much in line with standard mortgage fees. If it's a quirkier commercial or a higher value property, or even something where you need the valuer to drop everything and go tomorrow, then that of course can be reflected in the price. The key thing is keeping documentation moving. Some lenders will instruct the valuer and solicitors together, so they'll instruct the solicitor a lot earlier in the process to get a lot of the work done. It's all about keeping the transaction streamlined, keeping things moving and reducing the obstacles, reducing the barriers between all parties. And once the solicitors are happy, once the lender's happy, funds are released from there. So typically we aim to complete bridging within 2 to 4 weeks. Can be done quicker if needs be. We have seen cases take longer due to complexities with either planning or valuation issues or solicitors issues. Obviously every transaction is different, every case is different, but our rule of thumb there is that we aim to complete within 4 weeks on all bridging. So it is a flexible process. I'll just stress again, the most important part of a bridge is transparency and that flow of information, that flow of documentation. It's amazing how many times we get deals presented to us that have got very tight deadlines, 3, 4, 5 days in order to complete. And on day 4, you're still chasing for some basic information. With bridging, lenders ask for it because they need it. They don't ask for it to tick boxes. They don't ask for it because the system tells them to. Again, it's a very manual process for a lot of them. They don't want to be assessing things that don't make any difference to the transaction. So therefore, if a question's asked, then we'll work with you as the broker or with the borrower, or even with the solicitor and the valuer, in order to get the answer to that question as quick as possible. Because the minute we have that answer, we can work with it. We can do something. That might trigger a second question, depending on what the answer is. But the key thing is, let's get past that hurdle, past that barrier, and move on to the next part. The last thing we want to be doing is to be battling on the day of funding in order to answer questions that could have been dealt with weeks before. So the key part there is let's all work together. Let's make sure that we can get the outcome the clients are looking for, and let's make that customer journey, that customer outcome, as smooth as possible. So bridging finance, in summary, is a brilliant product to have in your arsenal. It won't suit every customer that you deal with. It won't suit every scenario for those customers. But what it will do is solve a number of problems. And these are problems that brokers come up against day in, day out, whether or not you realise it. So hopefully this has given you a bit more of a background into bridging finance. This has given you more of a feel about what the market looks like. And hopefully this means that the next problem that you're faced with, the next time you get a nil valuation on a property, or the next time you get a client wanting to purchase at auction, or has been let down by a lender at the last minute and has now got a very short time scale to complete, hopefully now you'll think bridge. Hopefully now you'll think crystal, and that we can all work together to get more and more positive outcomes for clients. We do run a series of webinars, we do run a series of podcasts and educational information throughout the course of the year. So please keep tuning back in. Please follow us on various channels so you're aware of what we're going out with. And for us, this is all about the year of education. We don't deal with customers direct, we deal with mortgage brokers. So for us, it's about ensuring that you are as equipped as you can be in order to spot the opportunities in front of you. A massive thank you to Together for sponsoring today's webinar. Thank you from me, thank you for your time, thank you for listening. I hope you found that interesting, and I hope to talk to you again soon.